What's up, guys? It's Cash Flow Cart. I'm so happy to be back recording. I took a little bit of a break, but I'm back now. We're going to go over that. Today, we are going to visit my dividend portfolio. We're going to check in on the performance, on the positions. We're going to talk about where and what I've been investing my money into in my little hiatus. But before we do that, we have a few things I want to cover. First off, guys, I know I haven't been consistent. Here's my lame excuse, and here's my background. So 2023, I left my job in corporate finance to pursue, my own style of investing, okay? To manage my own money, to master and hone in on my strategies and skills, and hopefully in the process be able to record and document and empower some of y'all. Okay, that's what I aim to do. I'm an individual investor. I invest only in dividend growth stocks right now, and I build a passive income stream that steps up year after year. Okay, I want you guys to understand I don't have a financial advisor. I am in the accumulation of wealth phase, and you don't need a financial advisor either if you are in that phase. You also don't need ETFs. You don't need to be paying large expense ratios. You don't need 4 or 5 perfect ETFs, guys. I want to tell you, you can be your own advisor. You can be your own fund manager. It's possible. I'm doing it. I want to surround myself with like-minded individuals and build the best dividend investing community that YouTube's ever seen. Okay, so let's do that. As you guys know, I took a little break in December. I was still investing. I was still keeping up with this market every day. However, I simply wasn't in the mood to talk to the camera. Okay, I was working a lot. I just wasn't really in that type of, that's a terrible excuse, but I'll put it this way. And I don't want you guys to think this is lame or soft, but I wanted to focus in, on my mental health, and I didn't want to force myself to record YouTube videos if my heart wasn't in it, okay? So I took a little break. My heart got back in it, and I wanted to record again. I was excited. I did a few, I think, in March. However, I had a bit of a professional shock in my career. I got a promotion at work to a management position. I knew I would be getting this promotion, and I knew that I would be filling this role, but it was kind of a 4 to 6 month training and transition period that was supposed to happen. However, it kind of just happened on a dime, like it was a phone call. Hey, you're taking over today, right now. Here's all the, logins and information and all that stuff. That was good. That was a blessing in disguise for me. But obviously, as a lot of you guys know, when you start a new job, starting out, you're doing a lot, okay? You're putting a lot of effort just to learn and keep up with the day-to-day and kind of figure out, what direction you want to take things, what days you want to accomplish certain things, how many days a week can you be in office to not get, burnout, etc. You're kind of locking in. I had to lock in, and, again, you start a new job, you're putting a lot of effort into a lot of stuff before, you fully kind of reel it in and get a little more comfortable with the position. Okay, so that's been really good, and I was investing, but during this time, I was, facing so much of my mental attention, so much of my brain power was going towards a lot of other stuff that recording for YouTube was not part of my daily day-to-day. And, that's sad, but I was still investing and I was still building the portfolio, and I've been, very blessed. But I'm back, okay? So that's enough lame excuses. And I'm going to say this. I also think I may need to readjust my approach to the channel a little bit, and I've had to do that as I've gone, okay? And now I want to aim for one video. I want to promise one video a month, okay? Hopefully with this, I can up the production, I can up the quality, I can film because I am passionate and I have something to say, not because I need to drop a video on Monday. No, okay, that's not what we're doing anymore. I'm gonna do at least one video a month. That's what we're doing moving forward, okay? In that video, I'll go over any new positions, any breaking news, any market updates that I need to cover, that I feel like I need to share, any wisdom I feel like I need to share, and I'll go over my portfolio, moves I've made and moves I plan to make, okay? So one more thing before we get into my portfolio, guys. Okay, there is some news on Hershey. Obviously, when there's news on a company you hold, you want to check it out. Okay, I'm not saying to react emotionally. I'm not saying to sell or double, triple down because of, news, because news is always going to happen. Okay, and a lot of news doesn't affect fundamentals. That's the truth. But let's still pay attention to news, and this one's on Hershey. So what happened, guys? Hershey has a new CEO. All right, this will be effective August 18th, okay? Michelle Buck is currently the CEO and president of Hershey, and she intends to retire. Okay, she's retiring. This is not breaking news. This is not a scandal. People retire. Good for Michelle. I'm happy for Michelle. But who's going to fill that role? The current Wendy's CEO. Okay, Kirk Tanner. I don't keep up with Wendy's news, but Kirk Tanner was not there very long. Okay, he will be leaving Wendy's and coming to be the CEO and president of Hershey on August 18th. Now, he hasn't even been at Wendy's very long because he was at Pepsi. And what's really interesting about this move from Hershey is Tanner's experience with Pepsi, okay? I don't know. I'm not necessarily too excited about a Wendy's employee taking over Hershey. That sentence alone doesn't get me too excited, but I am excited about a former Pepsi C-level employee taking over Hershey, okay? And the reason why Hershey has gone this decision, the reason why Hershey has gone this route is because of this experience at Pepsi. Why, guys? Okay, let's talk about why. Now, he took Pepsi from, a soda company into the PepsiCo we know today with, so many different businesses and companies they own. They're a snack business. Pepsi is now a snack and beverage business. Okay, it's not just soda. Okay, a lot of times we think Coke or Pepsi. The big difference is Coke is a beverage business. It's a beverage and soda business. Pepsi is snacks and beverages. Okay, very diverse. Pepsi is one of the greatest examples of diversification that we have in the stock market. Okay, Kirk Tanner helped them get there. Why is this important to Hershey? Well, they can hopefully diversify their revenue from chocolate, just like Kirk Tanner diversified PepsiCo's revenue. Same thing Hershey wants to happen here. Now, why? You say, why do they want to diversify from chocolate? Well, we're going to talk about that, guys. Cocoa prices. Okay, a lot of y'all have been keeping up with the channel, and I've talked about this for a while now, but as you know, April 15th of 2024, cocoa prices hit an all-time high, okay, of $7,984 per ton of cocoa, okay? Go back a year. It was at What are we doing here? No, wait. Sorry. On April 15th, 2024, hit an all-time high of $11,848 per a ton of cocoa. Go back a year, it was at $3,500. Okay, so it's a 3x climb. Okay, and we see Hershey get beaten down. Obviously, higher cost of input, the raw cocoa, creates less margins for Hershey on those chocolate bars. This is a big problem when chocolate bars are your entire business. When your cost of input, your main input, cocoa, doubles and triples on your main product that you sell, that's concerning. We see Hershey fall. Okay, we see this pullback happen. Not to mention, in 2023, what we have, and we covered it, we had Ozempic, okay, hitting a lot of these unhealthy brands. Hershey. It hit Walmart. You thought Ozempic was going to affect Walmart's bottom line? No, it would not affect Walmart's bottom line. But market sentiment said otherwise, and it did the same thing with Hershey. Okay, now the cocoa prices, that was a legitimate news factor, obviously. I mean, that's dollars. That's dollars that aren't hitting bottom line. But we see Hershey pull back. You see me start to build out this position. In April, I started building the position in April when when cocoa prices hit an all-time high. Now, what's interesting to this chart about me, oh my gosh, what's interesting to me about this chart is we said cocoa hit an all-time high in April and then pulled back and consolidated, right? Hit an all-time high, pulled back, consolidated. Why then has Hershey continued lower? Has Hershey broken down the consolidation it was in, during these all-time highs? To me, this says that there's a value arbitrage. Okay? A difference here that I, as an investor, can take advantage of. Okay? I would like to take this position to 100 shares. Because Hershey's trading lower while cocoa prices don't seem to be moving higher. In addition, we have former Pepsi C-level employee taking over the company as CEO. I'm interested. That's what I see. One other thing we'll mention on Hershey is this, and it's dividend yield theory. And it says here, create a free account to read the full article. No, okay, I'm not doing that. Because dividend yield theory saying Hershey is a buy is not an article. This is not a real article, okay? This is a fact. And let's visit what dividend yield theory is real fast. And then I'm going to take a quick break before the next segment, guys. Dividend yield on Hershey right now on a forward basis is 3.12%. Dividend yield theory essentially says that in order to determine if a stock is overvalued or undervalued, you take this current dividend yield and you compare it to the 5-year trailing average. So let's do just that. Go here. Dividend yield on a forward basis, 3.12. Like we said, Hershey, 5-year average, 2.27. Oh, wow, it's higher. 3.12% is greater than 2.27%, right? 37% higher, okay? So what dividend yield theory is telling me I'm getting 37% more bang for my buck in Hershey right now, okay? So $1 invested today is going to earn me 37% more income than it would have on average in the past 5 years. That's dividend yield theory. No, you don't need to read articles by Ted Waller. No shade to Ted, but
That's just not that's just not a catchy title. So that's my beef with Ted. And now we're gonna get into my dividend growth portfolio, guys.
Okay, let's look at the portfolio. The value of this portfolio is $76,938. Guys, it's pretty much an all-time high. I think on Friday it was at like 77.6 or 77.5. So, if it's within $1,000 of an all-time high, we'll go ahead and say, yes, my portfolio is trading at an all-time high. Actually, I guess you can see the highest close was 77.4. So we're pretty much at an all-time high. Today, we're down $200 and change. 1 year, we are up $17,000, 444. That represents 29.32% increase in the past year. Now, you might say, wow, that's amazing. That is amazing. It's great to be up 29% a year, but this does include capital invested, and we will do at some point a full performance breakdown. Okay, so, if I could keep this number in the high 20s every year for this portfolio, that's great. Whether it's capital gains, dividends, or net new capital, if I can keep that in the high 20s, I will get, very wealthy in a reasonable time frame. So obviously that would be good. But let's look at the income from this portfolio. Guys, I make $3,308 annually from this one. That's a monthly average of $275.68. Okay. Now, this isn't perfect. It's a little choppy. But I'm not really at the point where I care anymore. Just because, if your income's choppy month to month, you can still create an even stream of income, by taking out that average, in my case 275, by withdrawing that number every month. Okay, I say this because I think if you're just starting out, some investors fall into the trap of, I need to have a smooth income stream. No, you really don't, okay? And it's not like these payments are coming on the first of the month, okay? I could have a payment come the last day of September, okay? You see what I'm saying? So don't get caught up in this. The month-to-month thing is not very important. Focus on your average. For me, it's 275 for 33 total. All right, let's get into it. We will go ahead and sort by market value, guys. So Altria, my number one holding, I have 250 shares, trading at $59.63. That puts me at a market value of $14,900, and it pays me $1,020 annually. Okay, very important thing to think about here. And like I said, I will go through and kind of say where my head's at with each one. With Altria, okay, off the top of my head, this 14.9, that's roughly, and y'all can fact check this, but that's roughly 20%. It's roughly 21% of my portfolio's balance. Okay, so that's a large number. Even if Altria does present a buying opportunity, we'll see how interested I am in it just because of my allocation to it now. Even higher is the allocation of income I receive from Altria. Okay, just under a third of my income is coming from this one stock. Now, I believe in Altria. It's a tried and true company. It's a recession-proof company, like many of these sin stocks. But, obviously, there's allocation risk in this game. Let's look at the chart for Altria. Okay. Now, I pull this one up because it's been a very good example of my patience rewarding me. I've done a nice job with Altria. I've reviewed this example before. I'm going to do it again today. I identified this wedge pattern on Altria. Okay, I found the yield attractive. I found the valuation attractive based on the trailing 5 years, I started buying. Okay? I didn't rush. I didn't put all my capital in at once. No, I let the pattern develop and I built out the position. I built out this wedge and then I really put on kind of my last tranche here, at the end of, I guess it was 2023. Now Altria has rewarded me and has been on kind of an 18-month uptrend. It's up 50%. So I'm up 50% on this last tranche. Okay. That reflects the $40 mark to the $60 mark. Okay. That's where I get that 50% move up. The exact numbers, I'm in it at 44. It's trading at 59. Okay. So I'm up $3,768 just in capital gains, not counting how much dividend income I've collected. Okay, I'm not saying this to boast. Trust me, there's going to be bad examples too. But Altria is a good example, a very good example. I will say, I know we talked about my allocation risk on this one. I would be interested, potentially be interested into taking this position to an even 300 shares if and only if Altria pulls back to this support it's built for years. Okay, so if we see this red support line, if we see it come back into play, I would imagine it would be in the first or second quarter of 2026. Maybe I put on 50 more shares. I've got this box highlighted here. Maybe it should be moved to here-ish. If that happens, I'll do it. If not, I'm very blessed. I'm very happy with this Altria position. Moving on, we got Realty Income. Ticker O. I got 215 shares. It's $12,382 total, and it pays me $694. Okay, that's divided by 12 because this is not a quarterly payer. It's a monthly payer, which I don't care about. Like I said, don't get caught up in this. This is a vanity metric, okay? The smoothness of your annual income is a vanity metric, okay? And if you have basic financial literacy, you'll be able to understand that the average is much more important than the smoothness, okay? It's basic financial literacy. Moving on, guys. We got Hershey. I talked about it before. Got 72 shares of it, trading at $12,263 for the market value, and it pays me $395 annually. Let's go check it out, guys. Okay, we talked about this value arbitrage, and with that value arbitrage in mind, okay, I would like to add. Okay, I'd like to take this to 100 shares, and I would like that to happen on the back half of this year or the beginning half of 2026. Like I said, we'll see, hopefully, this blue line, that's the 50 moving average. We'll see it. Right now it's pointing down, very simple stuff. We'll see it flatten, and we'll see it start to point up. And as that happens, ideally, I lock in the 100 shares and build out a great cost basis. Okay, because right now this 183 cost basis on it, when it's trading at 170, it's letting me know that I could do better. Okay, I need to get this cost basis below 180. I just do, and I need to get the total position to 100 or better. Moving on, Pfizer. I have 385 shares. Market value of $9,861, and it pays me $662. Let's look at Pfizer. Now, we talked about how beautiful I did on Altria. We talked about how I've done pretty well on Hershey, but there's room for improvement. Pfizer is one that I have not done well on. So, while I was patient on Altria, I let the pattern develop, and I built out the position. With Pfizer, I rushed into it. Okay, I started buying this one as soon as it broke under 40. I caught a falling knife, like some investors or traders will say, and I kept catching a falling knife. Here's the 35 share tranche at 36, a 31 share tranche at 39, 15 more at 38, 16 at 36. And you see the smaller tranches are happening while it's lower. You know, I should have flipped this. I should have dipped my toes in with the 9 share tranches. The 3s, 6s, 7s. Then I should have unloaded these 35, 31. It would have been more, 45. I should have unloaded the bigger tranches after this one fell more and started to consolidate. Okay, that's a learning lesson. So I've got a lot of capital sank into this one. I'm down $1,600, but I'm not worried about it. It's a good lesson, and I think hopefully I could get this to 400 plus, you know, by, again, kind of this next 3 or 4 quarter time frame. We're going to see something similar with Pfizer as we're going to see with Hershey, where we see that 50 SMA on a weekly basis. What is that? It's a car alarm. It's not mine, so that's okay. We see that 50 SMA. We're going to see it flatten and curl up. Give me 1 second. Sorry about that. So we're going to see it flatten and curl up. And this one will turn into a pretty great position for me. But I could have done better. Moving on, guys. Pepsi. Okay, ticker PEP. 60 shares I have in my portfolio for a total value of $8,110. Pays me $341. And I'd like to continue growing this one too. Now, this is my newest position. Okay, I got interested in it. You know, as you can see, I put this tag on here. I thought it was going to make a run for that 144 level. You know, I put on some shares in the low 150s. I put on the bulk of it at 144. That's where I was interested. You know, I kind of computed that fair value calculation, if you will. Very hard calculation. I took this double top, essentially. Right in that mid 140 level. I thought Pepsi would hold up there off the double top. Okay, so I did a good job building it out. But, you know, we got to readjust. It broke down that level. And now I should definitely be adding more to this one as well. Okay, a lot of good opportunities. I've gone on, you know, I've now mentioned that 3 of my top 5 stocks I'm ready to buy more of. I think that's a good situation to be in, okay? You know, it's a good situation to be in. All right? There's opportunities. Where I need to focus on is when I have capital I'm investing, where's the best opportunity? Okay, I'm not spreading it amongst all these guys. That's not what I'm doing. And don't fall into that trap that so many investors fall into of, oh, I can invest $100 a month. I'm going to put $25 in SCHD, $25 in SPY, $25 in QQQ, $25 in Johnson & Johnson. Do not fall into that trap, okay? Put your $100 each month in the best opportunity. And next month, if that same opportunity is still the best opportunity, guess what? Another 100 in it. It might take months and months, and, you know, it might take years. But be patient and don't ever let up on putting your capital towards the best opportunity. Okay? And I've spoke on this before, but too many dividend investors I see today, they get this is a passive income strategy. I understand that. This is a passive income strategy, a set and forget, right? Kind of, but you've got to stay on top of your due diligence. You've got to stay on top of these charts, and you have to stay on top of, okay, where's my next dollar going? Okay, next up we got Starbucks at 70 shares. That one pays me $170 annually. Okay, after that, I'm not really interested in adding to Starbucks right now. We got Apple. I got 30 shares paying me. Oh, wow. That was really low. 30 shares of Apple paying me only $31 a month. This video is getting a little lengthy, but in the next one, I'll focus more on kind of these Apple Microsoft trims. 10 shares of Microsoft, same thing, $30 annually. And then lastly, T. Rowe Price, not one I've built a ton. I got 15 shares, paying me $76. Okay? Guys, thanks so much. Okay? Thanks so much for joining me for this video. I'm happy to be back on here recording. I'm going to continue doing this. I said it before. I'm going to have the updates coming out every month. I'm going to keep, pushing that short form content to try and grow this community. But I want to hear from you guys. I want to hear feedback. I want you to say, oh, Carter, I think you're writing off T. Rowe. Maybe you should take another look at it and consider building it. Carter, I think you're being, I think you were dumb to trim Apple. I think you were dumb to trim Microsoft. Why would you do that? Here's what I would have done. I want to hear from you guys. I want to learn from you guys. And I want to feel like this is a real great community. Okay, guys? So, again, thanks for watching. I'll catch you in the next one. Until then, this is Cashflow Cart. Thanks, guys. Let's build wealth.